All right, the last part of chapter 13, we have cash dividends. So, a profitable corporation may make distributions to stockholders in the form of dividends. Dividends can be paid in the form of cash, stock, or other property, and we're going to practice with dividends being paid in the form of cash. Let's go over some main components just so we can understand when journal entries are actually recorded, and we'll see that we're going to do that in the sample problem. So there's three dividend dates that are relevant. There's the declaration date, the date of record, and the payment date. The declaration date, this is the date the board of directors announced the intention to pay the dividend, and then a liability is created. So the board of directors got together and said, hey, we're going to issue dividends. And since they said that, now a liability is created. And so in order for us, since there's liabilities created, the accountant's going to make a journal entry. So we're going to write down here just so we know a journal entry is done. All right. And then the date of record, this is the date on which the corporation checks its records uh, to look to identify the stockholders, whatever stockholders are out there at this date, how many shares they own. Those are the stockholders that will receive those dividend checks. And so that's just looking up to see what stockholders are there. And so we know who we're going to issue checks to. So there's no, for accountants, we don't care about this. There's no journal entry. So no journal entry. And then the last date is the payment date. This is the date the dividend is paid to the stockholders. So checks are being uh, paid out to the stockholders. So of course there's going to be a journal entry because goodbye some cash to pay those stockholders. So yes, the accountant cares about this one. Journal entry is done. So we can see here two dates that are important for us as accountants. We have the declaration date because we're going to record a journal entry, and then we have the payment date because we're going to record a journal entry. And so that's what we're going to practice with over here in the next problem. So let's go ahead and open that up here. And so we can see here that we have the company earned a net income of 85,000 during the year end of December 31st, 2018. On December 15th, we can see I got the name wrong here. They declared annual cash dividends on its 4% preferred stock par value of 120,000 and a 25 cents per share cash dividend on its common stock that's left, and they said it is 50,000 shares. So Archer then paid the dividends on January 4th, 2019. So we have two journal entries that we need to record. The first one is to do an entry for declaring that cash dividend on December 15th. So that's when they created the liabilities. Said, hey, we're going to issue these dividends, and so now we're going to have a liability that we need to create. So in this one, we have two types of stock. We have preferred and common stock. So we'll have two different types of liabilities. So we'll have a cash dividend to record. That's when it's created. And then we'll have two payables. So we'll have dividends payable, and that will be preferred. And then we'll have dividends payable for the common. All right, perfect. So we'll have two liabilities and then our debit for the cash dividends. So we need to just do a little bit of math. We need to calculate the preferred first. So let's go ahead and do that. So that was 120,000. That was the par value of that preferred stock. And the cash dividend is 4%. All right, 4% preferred stock. So we'll say, okay, so that's going to be 120,000 times, let's do a different color, just so it's highlighted more for us. And we don't need that bolded. There you go. All right, and it was 4%, so 0.04. And so that equals 4,800. All right, so 4% is the cash dividend on that preferred stock. The par value is 120, so times 0.04, that gives us 4,800 for the dividend payable. Not too bad. And then we have the common stock, and so that is 25 cents. So we can see here 25 cents per share, and there's 50,000 shares left. So we'll just do a little multiplication as well. 50,000 times 0.25. Let's put a dollar sign in front of that one. There we go. And so we can see that is 12,500. Not bad. There's our two liabilities. Add those up. That's my debit. That is my cash dividends. So 4,800 and 12,500 is 17,300. Perfect. Not too bad. All right, let's keep going. So now we're going to journalize the entry for paying the cash dividends. So you remember, they went and they had this liability created, and then we don't worry about the date. If we were looking at dates again here, and we can see that this is the payment date, and that's when an entry is done. So cash is going out now. Now we're paying these liabilities. Very easy. Oh, I forgot to put dates on here. Let's do that. This is 2018, and that's December 15th. All right, and it's now January of 2019. Perfect. So we got to get rid of our payables. Not too bad. And just debit them. So this is probably the easiest problem of the three. Oh, did I go the wrong way? I went the wrong way. Look at that. I'm saying it's the easiest problem of the three, and I went the wrong way. The comment was 12,500. There we go. And then we're paying out cash. So cash is crediting. We're cutting those checks. There you go. And that is it. That is our journal entries for cash dividends.